Hi friends, welcome to EduTap. So today we are going to discuss a very interesting topic. This topic is with regard to accounting for foreign exchange rates. Now in today's globalized world, every big company is having some foreign exchange transaction. Every company may have a subsidiary abroad, a branch abroad as well. So how do we record these transactions in the books of accounts? How do we account for these transactions while preparing our financial statements? So this is what we are going to learn today. Let's start today's discussion. So let's start with the first question. Which accounting standard deals with the issues involved in accounting for foreign currency transactions and foreign operations? So we are simply being asked which accounting standard it is going to provide us guidance, it is going to provide us rules and regulations with regard to foreign currency transactions and foreign operations. Options are AS3, AS11, AS13 or AS21 or none of the above. So let me try to build a background for this particular accounting standard. Okay, why do we need an accounting standard for foreign exchange? What was the need behind it? Now suppose I have a business. I have a business of buying and selling mobile phones, and suppose I buy 100 phones from USA. Okay, and I buy these phones at $500 each. And I have made this purchase. I have made this purchase on 1st of the Feb 2021. On this date, let's suppose the exchange rate was $1 is equal to rupees 60. Okay, this was the exchange rate. Now this happened on 1st of February 2021. Now what happens now on 31st March 2021? On 31st March 2021, I still have these phones in stock with me. I have sold 50 phones, but 50 phones, they are still in stock with me. I have stock of these phones. And also the payment is still pending in respect of the mobile phone. The payment which was to be made, how much I had to make? I have to pay $500 for each. Yani ki I had to pay $50,000 I had to make payment. I have still not made this $50,000 worth of payment. This is still pending. And this payment is actually made on 15th of April 2021. I have made the payment of how much? I have made the payment of $50,000. Exchange rate on 31st March 2021. Let's suppose it was $1 is equal to rupees 70. And on 15th of April 2021, let's suppose it was $1 is equal to rupees 80. Okay, so this was the exchange rate on these particular dates. Now problem is going to definitely arise. How the problem is going to arise? We are having 3 dates. We are having 3 exchange rates for these particular dates. Okay, we have these 3 dates. On the first date, when I bought the mobile phones, at what price should I initially recognize this particular amount in my books of accounts? I am in India. I have to record this transaction in rupee terms. So at what exchange rate should I record this particular transaction? Now the problem is going to again arise on 31st March 2021. On 31st March 2021, I am going to have this stock with me and the payment is still to be made. It is pending. And now the dollar has got even more expensive. $1 is now rupees 70 and this payment is still not made. Now at what amount should I record the creditors in my books of accounts? And what about the stock? How should I record it? Again, on 15th April 2021, I make this payment. And now I'm making this payment at $1 is equal to rupees 80. Earlier it was rupees 60, then 70. Now it is rupees 80. Exchange rate, it has again, it has the dollar, it has again got more costly. So now how should I account for all these differences in exchange rate, changes in exchange rate, all the transactions that I am making? There can be another set of scenario. Another set of scenario can be, suppose I am a big business. Okay, I'm a big business and I am having my operations. I have opened a branch at Singapore as well. My operations are at Singapore as well. And in Singapore also, I am buying and selling the mobile phones. Okay, so one case can be, so here one case can be case A and case B. One case can be where the mobile phones in Singapore, they are sent from India by me. Mobile phones, they are sent from India by me only. I take control of the entire operations at Singapore. Mainly everything is under my control only. I send them stock, I send them everything. Most of the transactions they do, they are with me only. So this can be one of the case. And there can be another case, case B, in which the mobile phones, they are being bought independently. They are being bought independently from Singapore or from some other country, and they are being sold independently. I have just made investment. I have just invested in this particular business. I'm not controlling it as such. I've just invested money in this particular business. So how to account for these foreign businesses? When at the end of the year, I'm preparing my financial statements, there is a concept of consolidated financial statements. Okay, what is this concept? Consolidated financial statements. So it tells us that you have to consolidate your branches, your subsidiaries as well while preparing your financial statements. So if I have to consolidate this case A or this case B, this company that I have opened in Singapore, this subsidiary, this branch I have opened in Singapore, if I have to consolidate it with my books of accounts, if I have to consolidate its balance sheet with my balance sheet, how should I proceed? Because its balance sheet may be in Singapore dollar, it may be in dollar, but my balance sheet is going to be in rupee. How do I convert? How do I translate it in rupee terms? So there are going to be all those sorts of issues which are to be addressed. And these are what they are being addressed by this accounting standard. This is accounting standard 11, a very important one which deals about the foreign exchange transactions. So friends, accounting standard 11, it deals with the issues involved in accounting for foreign currency transactions and foreign operations. Okay, it tells us which exchange rate to use, whether I should use $1, rupees 50, 60 or 70. Okay, and how to recognize the effect of changes in exchange rate. The exchange rate is changed from 60 to 70 to 80. How to recognize this its effect on the financial statements. This standard should be applied in accounting for transactions in foreign currencies. Okay, so if I had bought 100 mobile phones in US dollar terms, so this accounting standard is going to be applied. This is applied in translating the financial statements of the foreign operations. So if I am having some operations at Singapore, to translate those operations to Indian currency, I am going to apply this accounting standard. It also deals with accounting for foreign currency transactions in the nature of forward exchange contracts. So sometimes you enter into forward contracts relating to foreign exchange. So this accounting standard, it also applies to this particular case. So primarily it deals with A and B, these two cases, and this is what is going to be our key area of discussion in the next questions. So now we can easily answer that AS11 is going to be the right answer. Now moving on to the next question. As per AS11, a foreign currency transaction should be recorded on initial recognition in the. Okay, so now this question is asking this thing, that when you enter into a foreign currency transaction, for example, we bought 100 phones, $500 each. Okay, on 1st Feb 2021, exchange rate was $1 is equal to how much it was? Rupees 60 we had assumed. Okay, so this was the case. Now, how do we record this transaction initially in the books of accounts? So it says whether you would be recording in the reporting currency by following the exchange rate at the date of transaction, whether you would be recording in the foreign currency by following the exchange rate at the date of transaction, whether in the reporting currency by applying the exchange rate at the beginning of the financial year. Suppose on 1st April 20, on the beginning of the financial year, the exchange rate was $1 is equal to rupees 50. You are also aware about this exchange rate as well, whether you should follow it or the exchange rate at the date of transaction. Whether you should report in the foreign currency by applying the exchange rate at the beginning of the financial year. So these are all the options which are given to us, and we have to take out the right answer. Just think logically, think about it and try to mark out which should be the right answer. So now this accounting standard 11, it defines foreign exchange transaction. It says a transaction in foreign currency is nothing but a transaction that is either expressed or requires settlement in a foreign currency. So if we had bought mobile phones, of $500 each, this is a transaction in foreign currency because it is to be settled in foreign currency. It is expressed in foreign currency and it is also going to be settled in foreign currency. So foreign currency transactions are going to include transactions like buying or selling of goods or services which are expressed in foreign currency, like for the mobile phones. We are making some borrowing or we are lending some funds where the amounts receivable or payable are expressed in foreign currency. You have given some loan abroad in US dollars. You have taken some loan from US in dollar terms. So then again it is a foreign exchange transaction. The one where we are party to a foreign exchange contract, and one pertaining to purchasing or disposing of assets, incurring or settling liabilities which are in foreign currency. We are buying any asset in foreign currency, we are incurring or we are settling any liability which in foreign currency. So they are all foreign currency transactions as per the accounting standard 11. So quite simply we can say that any transaction in which dollar comes into picture, foreign currency comes into picture, that is going to be a foreign currency transaction, and this accounting standard is going to tell to us how should we proceed with this transaction. So now with regard to the initial recognition of the foreign exchange transaction, initial recognition means how you would be initially recording this transaction in your books of accounts. How would you be making a journal entry for this transaction that you have entered into? So in our case, we had bought 100 phones at $500 each. So we had this liability of $50,000. So how would you record this liability initially in your books of accounts? How would you make this general entry? So now the general entry would be like, we are making purchases. Okay. So in this particular case, the purchases account is debited and we are making these purchases, and for this we have to pay some amount. Suppose this purchase was made from A Limited. So we are going to pay to A Limited in future. So we are going to credit A Limited $50,000. We cannot write this transaction in dollar terms because we are in India and our journal is only going to take transaction in rupee terms. So we have to convert it into rupees. Okay. So how do we convert it into rupee? Just use the exchange rate at the date of transaction. So at the date of transaction, $1 it was rupees 60. So use this particular exchange rate, 50,000 into 60. This is going to be how much? This is going to be 50,000 into 6 is 3 lakh. So 60 is going to be 30 lakh. So this is going to be 30 lakh. You record this transaction like this in your books of accounts. So at the time of initial recognition, you have to report in the reporting currency. So reporting currency is your local currency in which you are reporting all the other business transaction. So this is the currency which is used by the business entity to report its business transactions in the financial statements. So being an Indian entity, we use rupee as the currency to report our transactions in financial statements. So this is going to be the reporting currency. Now we have to convert the dollar amount to rupee. So we have to adopt an exchange rate to do it. This exchange rate should be the one which prevails at the date of transaction. So this is about the initial recognition of foreign exchange transaction. So we can easily answer this question now, that initial recognition is to be in reporting currency by following the exchange rate at the date of transaction. So answer is going to be option number A. Now let's move on to the next question. As per AS 11, at the balance sheet date, foreign currency monetary items should be reported using. So now what is going to be this particular case? So we bought, how much phones did we buy? 100 phones, $500 each. So we had to make this payment of $50,000. Okay, this payment is still not made on 31st March 21. So at the balance sheet date, this $50,000 is still pending. Okay, so how should we report this transaction? At which exchange rate I should convert this $50,000? Whether I should use the exchange rate at the date of transaction, whether I should use the average rate of foreign exchange for the year, whether I should use the closing exchange rate, whether I should use the lowest rate of foreign exchange for the entire year, or none of the above. So this is what is being asked in this particular question, that by which exchange rate you should convert this $50,000 into rupees on 31st March of 2021. So just think about it logically and try to answer it. So now let's learn about reporting monetary items at balance sheet date. Okay, at the balance sheet date, the accounting treatment is going to depend on whether the item is a monetary item or whether it is a non-monetary item. So there can be two types of items which can be there. So this standard, it defines what is a monetary item. It says it is the money which you are holding, suppose any foreign currency which you are holding, and it also includes the assets and liabilities which are to be received or paid in cash. Okay, so now in our case, we had bought 100 phones, $500 each. We had to make payment of $50,000. So we had to make payment to A Limited. This A Limited is sort of our creditor. It is our liability. So this is a liability to be paid in future in foreign currency, in money terms. So this is definitely going to be a monetary item. So how should we report this liability in our balance sheet? So this accounting standard says if it is a monetary item, you should report it using the closing rate. Okay, the date of transaction, the rate, it was $1 is equal to rupees 60, and now on 31st March the rate is $1 is equal to rupees 70. Okay, so initially we recorded the transaction and the amount was 30 lakh 50,000 into 60, it came out to 30 lakh, and now 50,000 into 70, how much this is going to be? This is going to be 35 lakh. So now this amount has sort of increased. The amount of liability, it has increased. Now we have to make payment to A Limited not 30 lakh but 35 lakh as per the exchange rate prevailing on the balance sheet date, as per the closing exchange rate. So now this increase in rupees 5 lakh, this is sort of an expense, this is sort of a loss for us. तो यहाँ पे हमारा 5 लाख का बैठे बैठे नुकसान हो गया. So all the nuksans, all the expenses, losses, they go to statement of profit or loss. So it is to be recognized in the financial statement. It is to be recognized as income or an expense in the period in which it occurs. So it is to be recognized in your statement of profit or loss. Since it is a loss for us, so it is going to be recognized as an expense or loss in the profit or loss statement. So this is the treatment with regard to the monetary items at the balance sheet date. So very simple. Apply the closing rate, the difference between the transaction rate and the closing rate, it is going to be your income or loss, and you have to report it in your statement of P&L. Now what about the non-monetary items? So any item other than monetary item, it is non-monetary. For example, you bought some fixed asset from abroad, you bought inventory, you made some investment. Okay, they are all non-monetary items. So it is clearly being specified what are these non-monetary items. So in our case, we had bought inventory, we had bought stock of phones from abroad. Now some stock, it may still be pending with us. So this stock is to be how it should be recorded in the books of accounts as on 31st of March. So for this particular purpose, we do not have to consider the exchange rate on 31st of March. $1 is equal to rupees 70 is not going to be applicable in this particular case. We have to consider the exchange rate at the date of the transaction. For example, if I had bought some machinery, okay, let's take another example. I had bought some machinery from abroad. Now this machinery, it was bought for $1,000. Okay. Now this machinery is to be recorded in my balance sheet as an asset. Now at what price I should record this particular machinery? Now this machinery I have already bought. I may have made the payment or I may not have made the payment. That is a separate issue. But how do we record this machinery? Okay, this machinery has to stay with me for a long period of time. Now I should not change its value every time in the balance sheet because it may get misleading. If I change my value every time, it may seem to be that I am buying another machinery or I am selling some machinery, that's why amount is fluctuating. So that's why this $1,000 at the date of the transaction, the rate was $1 is equal to rupees 60. So now you are going to report this transaction, report this machinery at rupees 60,000 only in your balance sheet. You are not going to change its value on every balance sheet date. You are not going to apply the closing rate. You are only going to follow the rate which prevailed at the date of the transaction. No closing rate is to be applied. This is something which you have to remember. For monetary items, apply the closing rate. For non-monetary items, just apply the rate at the date of the transaction. So now we can easily answer that foreign currency monetary items at the balance sheet date, they should be reported using the closing exchange rate. So answer is going to be option number C. Now next question, in case of dash operations, individual items in the financial statement of the foreign operations are translated as if all its transactions had been entered into by the reporting enterprise itself. Integral foreign operation, non-integral foreign operation, both integral and non-integral foreign operation, new foreign operation or none of the above. So यहाँ पे ये सवाल हमसे पूछ रहा है कि आपका बाहर कोई foreign operation है, you have a business abroad. Now, how would you consolidate that business financial statements with your business? You have to convert, you have to translate it in rupee terms. So how would you be doing it? Okay, so this is what it is asking. In which sort of foreign operations, which kind of method is what is going to be followed by you. You are a reporting enterprise in this particular case. The reporting enterprise is the entity which is preparing the financial statements, which is going to translate the financial statements of its branch or subsidiary abroad into rupee terms. That is a reporting enterprise. Now we already talked about in the introduction slide, okay, when I explained to you about the foreign operations, I told you there can be two cases, case A and case B. In the case A, the foreign operation that I was doing in Singapore, the company that I had, it was entirely being controlled by me. It was just an extension of my own business. I was supplying all the goods there. I was mainly transacting with that particular company. So it was a type of integral foreign operation. And in the case B, what I was doing, I had just made the investment in the company in Singapore. The company was operating independently on its own. So it says that the method which is used to translate the financial statements of a foreign operation. So there are two types of foreign operation, okay? Foreign operation A, foreign operation B. We are going to have financial statements for it and financial statements for it as well. So it says it depends on the way in which it is financed and operates in relation to the reporting enterprise. Reporting enterprise is nothing but the Indian company. Okay. So we are going to see the relationship. We are going to see the relationship of the foreign operation, foreign company with the Indian company. So it says that there can be an integral or non-integral foreign operation. Integral foreign operation carries on its business as if it were an extension of the reporting enterprise operation. For example, in case A, it is a clear case of integral foreign operation because everything that is being done is controlled by the reporting enterprise, by the Indian company. Such an operation might only sell imported goods from the reporting enterprise and it may remit all the sale proceeds to the reporting enterprise. तो वहां पे जो बिजनेस हो रहा है सिंगापुर में सारा स्टॉक मैं भेजता हूं और जो वहां पे सामान बेचते हैं सारा पैसा वापस मुझे भेज दिया जाता है. So it is sort of an integral foreign operation, sort of an extension of my own business, sort of a branch that I've opened in Singapore. There can be another case, that is non-integral foreign operation for the case B. Now in this particular case, this entity is operating, company in Singapore is operating, it is doing its own business, it is generating the income, it is incurring expenses, arranging its own borrowings, arranging on its own funds substantially in the local currency itself. So it is primarily working on its own. So it is a non-integral foreign operation. So now, how are you going to translate the financial statements? This is going to be dependent on whether it is a integral foreign operation or it is a non-integral foreign operation. I believe you are aware about the difference between the two. For integral is sort of a branch of mine in Singapore and non-integral is sort of an investment of mine abroad. Now how to translate foreign integral operations? Okay, the integral operation, sort of a branch of mine which has been opened abroad in Singapore. The case A, it is being talked about here. So it says, when we are talking about the financial statements, the individual items in the financial statements of the foreign operations are translated as if the transactions had been entered into by the reporting enterprise itself. तो सारी transactions जो कि हो रही हैं केस नंबर A में सिंगापुर वाली कंपनी में, उनको ऐसे रिकॉर्ड किया जाएगा जैसे इंडियन कंपनी ही उन transactions को कर रही होती. So suppose if the fixed assets are being purchased, they are going to be translated using the rate of exchange on the date of purchase, as we have already understood about the recording of foreign exchange transactions. Similarly, the inventory is going to be translated using the exchange rate when the inventory was purchased. So we are going to assume all the transactions are happening as if the Indian company was doing them. Indian company जिस हिसाब से उन transactions को record करती, उसी हिसाब से उनको translate किया जाएगा. So as simple as that. Now what about non-integral foreign operation? Okay, for a non-integral foreign operation, which is not an integral part of mine, it is not my own branch, it is rather working independently. So in this particular case, the assets and liabilities, either monetary or non-monetary, they should be translated at the closing rate. Okay, so now for the foreign operation, I would be having the balance sheet of the Singapore company and I would be having the profit loss of the Singapore company. So in the balance sheet, I have to just convert everything to the closing rate. I have to apply the closing rate for monetary and non-monetary items, all of these. For the statement of profit or loss, the income and expense items, they should be translated at the exchange rate at the date of the transaction. So I have to follow the exchange rate which were there at the date of the transaction. If there are lots of transactions, sometimes average rates they are also being applied. Now there may be some differences which arise as a result of the differences in the changes in the exchange rate. So if any differences arise with regard to changes in exchange rate, we have to transfer them to a separate reserve, which is foreign currency translation reserve. So because of the translation of the financial statements from dollar to rupee, sometimes certain differences arise, and this difference is transferred to a separate account, which is foreign currency translation reserve, and this account is maintained until the disposal of my investment, until I dispose of my stake in the Singapore company. Till that time, this account is being maintained. So now we can easily answer this question that in case of integral foreign operation, individual items in the financial statements are translated as if all the transactions had been entered into by the reporting enterprise itself. So clearly answer is option number A. We have understood about the integral and non-integral foreign operations, and we have understood how to translate the financial statements of these in the reporting currency. Now there is a question for you guys. Okay, this question has to be solved by you guys. This question is, goods were purchased on 1st of January 2021, $500. Okay, $500 worth of goods were purchased. Exchange rate was $1 is equal to rupees 70. Exchange rate on 31st March 2021, it was $1 is equal to rupees 60. Actual payment on 7/8/2021, $500 was paid. Exchange rate was $1 is equal to rupees 50. How much gain loss is to be recognized for the financial year ended 31st March 2021? So just think about the monetary and non-monetary items. How do we record the exchange differences? Okay, so now we know that first we will be doing initial recognition. Okay, initial recognition would be done. How it would be done? You have to think about it. You have to just try to solve it yourself first, and then think about the monetary items, how they are reported at the balance sheet date on 31st March 2021. How do we report it? And think about the difference that is going to arise and how you are going to treat this particular difference. Just think about it and you will get the right answer. So let me try to answer this question for you guys. Okay, so initially what happened was we purchased some goods, and on the date of transaction the exchange rate was $1 is equal to rupees 70. So $500 into 70. Okay, so rupees 35,000. This was the amount of transaction which was recorded in the books of accounts. We booked our creditors for rupees 35,000 at the date of the transaction. Now at the balance sheet date, the exchange rate, it has changed. Now the exchange rate is $1 is equal to rupees 60. So now this is going to be $500 into 60, rupees 30,000. I am going to report the creditors at rupees 30,000. So initially I reported at 35,000. Now I am reporting at 30,000. There is a difference of rupees 5,000. How do I record it? Initially I had to make payment of 35,000. But now as per the prevailing exchange rate, I only have to pay them 30,000. So there is a clear cut gain of rupees 5,000 that has been made. And this gain is going to be an exchange profit, which is going to be transferred to the profit and loss account. So this is an exchange profit, which is going to be transferred to the statement of profit or loss. So now we can easily answer this question that the exchange profit of rupees 5,000 is going to be there. So gain rupees 5,000, option B is going to be the right answer. Now just also think about the actual payment date. This was not relevant to us for answering this question, but in this particular case, suppose if we also consider the actual payment date. Okay, if we have to answer how much revenue we would be booking in the financial year ending 31st March 2022. So in this particular case, the exchange rate, it has further declined to rupees 50. Okay, now on 31st March, we had recorded the creditors at rupees 30,000. Now at the time of the payment, I am making payment of how much? $500 into rupees 50. This is the exchange rate. I am making only payment of rupees 25,000. So again, a gain of rupees 5,000 is going to be there. This gain is going to come in the next financial year, that is financial year ending 31st March 2022. So in that financial year as well, I am going to transfer this gain to my statement of profit or loss. So this gain of rupees 5,000 is going to be booked in the next financial year. So if we were asked about the gain to be booked in the financial year ended 31st March 2022, then also the amount would have been rupees 5,000. Answer is option number B here. So thank you friends. This was all about our discussion with regard to accounting for foreign exchange transactions about the AS11, the rules contained therein. Now this AS11 is a bit complex one. Okay, I admit it is a bit complex one, but I have tried to explain all the things in a very simplified manner. I'm very sorry if I had become boring in between somewhere. I'm very sorry. This is all about the rules that I have to teach you. So I believe I have made you understand all the rules, all the important points in this accounting standard. So this is all for today. Thank you. Bye bye. Take care and keep working hard.